Hi, everyone. Welcome to the January 2023 Borrower Briefing by SkyView Partners, where we will be diving into the state of the lending market for RIAs and independent financial advisors. My name is Mike Langford, and I am the host of the Advisor Financing Forum podcast by SkyView. And today I'm joined by Chris Jewett, one of the co-founders and a managing partner at SkyView, and Nick Barker is back, SkyView's Chief Banking Officer. As with our prior webinars, you can expect a vibrant and conversational experience today that is designed to make the topic of commercial lending for financial advisory businesses approachable for you and your business partners. Before we get started, please remember to subscribe to the Advisor Financing Forum podcast on Apple Podcasts, Spotify, Google, YouTube, or wherever you like to podcast jam on. And we will be posting a recording of this webinar on those feeds just in case you want to listen to it or watch it again. And if you have a question about the topics covered in today's webinar or something more specific about your financing needs, please swing by skyview.com or call 866-567-6282, and the SkyView team will be happy to walk through the options that are best for you and your business. Okay, let's get to it. Great to see you, Chris. Nick, how's it going today?
It's going great. Yourself?
It's fantastic, man. I got through that intro. Maybe a little bit choppy, but I'm thrilled that we're here. And by the way, for those...
We're proud on our end.
You should be proud of your end. That's great. Anyway, well, for those of you who noticed the train in the background of Chris's mural, we actually had a real train coming through right before this recording. So very excited. Hopefully we're bringing the thunder here for our audience today. So really looking forward to it. So let's go ahead and dive in. Why don't we start things off with a bit of a state of the market update? It's January 2023. Rates are quite a bit higher than they were last year at this time, excuse me. How has the lending environment for RIAs and independent financial advisory businesses changed in response to rising rates?
Yeah, definitely great question. Rates a little bit higher than they were last year. In terms of lending environment, we've really seen minimal impacts to deal flow on the advisor side. And then I'd actually say an increased interest from the funding institution perspective. From the funding source side, many of the other lending verticals that they're operating in, take it like commercial real estate, are struggling right now with the increased rates relative to 12 to 24 months ago. A lot of those projects are infeasible now. So with that, I mean, we've really not seen a negative impact on the funding side or on the advisor side as it comes to the ability to fund these opportunities.
Well, and I think you also have the area here where on these types of loans and cash flow loans and actually appreciating assets versus depreciating assets, when you're borrowing money on these types of transactions, the difference in rate, whether it be 5% or 8%, doesn't move the needle too much on your actual, what is the rate of return on your investment here. Now, obviously, it touches the cash flow here a little bit, so we can look at that. But the actual ROI, when an investment advisor is buying one of these practices versus other asset classes out there, it just doesn't move the needle that much from how that, again, 5% is to the 8%. The other thing that Nick talked about a little bit is these funding institutions are in need of putting money to work because some of those other verticals just aren't as attractive or calling for lending. It's put more banks' eyes on this space, or more of our funding partners to have more of an appetite for these. So it's actually a great time as a borrower to be able to get the most amount of eyes on these things to potentially have the most creative solution and or find the right partner for them as they're looking to grow their business.
I think that's a really good point, Chris. Like it's just so basic when you think about it for a few seconds. These companies are in the business of lending money. They want to lend money. So it did not just dry up the fact that they're looking to put money to work. But obviously, there's a few changes probably that happen in terms of like maybe they're looking a little closer at which businesses to lend money at than they may have been in prior times or whatever. But let's dive into your perspective at SkyView, right? We're coming off a period where rates were at historic lows. So the fact that we've saw a lot of borrowing and M&A activity or for other use cases in the industry shouldn't surprise anybody, right? When money's cheap, everybody wants to borrow it. But now that rates are kind of closer to historic norms, What are you and the team at SkyView doing differently than maybe you had done over the last couple of years, if anything?
I think one of the things that we're really trying to do now is focus on options
Mm.
because everybody's different. So, one of the changes that we made across the board that we think benefits everyone is we started pegging our rates off of the Treasury instead of Wall Street Journal Prime. And really, we did that in an effort to alleviate any timing pressures that might happen surrounding Fed meetings and trying to get those closings. So, closing a deal is already difficult. So we want to make sure that we alleviate any sort of outside pressures that we can, much like rising rate environment and having to battle with those timings. And then another thing that we've done is offering variable rate options and shorter term loans for clients who'd rather participate in the interest rate speculation game. So I think, Chris can probably elaborate a little bit more too on that, but two great options for clients if they want to go fixed or if they want to go variable and kind of play the market a little bit.
But we laugh about the crystal ball, right? What is the crystal ball saying what a rate's going to do over the next, 60 days, 6 months, or whatever it may be? But I think the conversations are starting to be there on the rate side of it, where are we starting to crest or get to the top of the hill here a little bit from a rate deal? So some of the conversations are, would I rather operate in a rate agnostic world? I just want to fix the rate for a 7-year type term or 10 years, whatever the options may be out there. Or do I think rates are going to be lower in the next 2 to 3 years? So I'll take a little bit of exposure on what they think is the front side on the rate, on the rates. And with the bet in their crystal ball that rates will be lower then, so they get the upside in it, right? Over the term of the loan, it's going to be better for them. Now, again, we don't know where that's going to be, but that's how we look at a lot of these things, right? A lot of these advisors / operators are trying to look at this from more of a business perspective of how they're going to scale their business, and a lot of those things are looked at that way. But I think, to be clear, some of the things that have changed too from the lender's perspective or the funding institutions, they're more comfortable in this space. And so the structures or parameters at which they were willing to lend money a year ago or 3 years ago is vastly different today. And it's actually not more restrictive because the market's got more volatile or the market's down a little bit or rates are higher. It's they understand these businesses better. They're more comfortable with them. They understand what a partner is from a banking perspective and helping them grow, again, this appreciating asset. So it's changed. We continue to educate not only the advisor or the independent wealth manager, right, on how they can use this, but also the funding institutions on how this asset class reacts. So it's a constant education to both sides of it because they're new working together.
You've mentioned this a couple of times that the funding partners that you work with are looking very favorable at this segment, and particularly now, right? Because as I'm sure many of the advisors in our audience will attest, there's a lot of negative news in the air right now. We're seeing some layoffs. I think Microsoft just recently laid off something like 10,000 employees or something like that. Sales declines are happening in some segments, or we're starting to see companies that never discounted their stuff before offering discounts, right? So there's obviously an air of we're a little bit nervous in some segments of the economy. Yet, as you've been talking here, Chris, SkyView's funding partners are feeling quite optimistic about lending to RIAs and independent financial advisory businesses. What's driving that optimism and confidence in this segment?
Well, COVID was a big part of it, to be frank. And what happened in the when COVID hit us and when we went into lockdowns, a lot of their asset classes, had to shut their doors. Restaurants, all the types of things out there that weren't able to continue to create revenue to then go not only pay their employees, but if they had loans and everything else that was out there, right? So and that was something that nobody ever predicted, right? If you put together a business plan and you put in there, hey, for a 6-month period, we're going to have zero revenue before you started that business, that would end up in the circular file or the garbage, right? You just wouldn't do it. Well, everybody had to experience that, which is why the CARES Act came out and all these bridges to get everybody through it. And what happened was our funding partners and banks in general, as they were watching these asset classes, and as we went through one of the worst quarters in the history of the market, what they saw is how these things reacted, in that their cash flow continued. The stock market has only been closed more than 3 days at a time, once or twice ever. Right? 9/11, it was closed more than 3 days. And then maybe there was another time well before that, but that I just don't know off the top of my head. But again, the stock market continues to happen. The global economy continued to work, right? And so what that does is produce, and the clients needed to continue to get advice, which these advisors give. So the cash flow nature of these businesses, right, continue to produce that, which they're able to continue to not only pay their employees, but pay their rent and pay their debts. So from a funding institution level, they've got so much more comfortable with the recurring revenue nature of these businesses that they're, again, willing to look at being not only more creative in the way they've done it, but more in line with how other verticals borrow money, right? And then again, the nature of the recurring revenue and the public markets funding this, it's made them more comfortable.
Yeah, that's smart. And we were talking yesterday in our prep call before this webinar here that, this is when advisors go to work, right? Like this is, they start communicating with their clients. Like the really good advisors are reaching out to their clients, and their clients are actually looking for help. Like when they were panicking during the pandemic, like what's going to happen to my retirement fund and my college fund for my kids and so forth. Who's the person they're calling? Who do they want to talk to? So the businesses in some respects have strengthened over the years. And that's probably true. Even though we're in a down market right now, that's likely strengthening the relationships as well. Are you seeing that as well when you talk to advisors?
We see it a lot. And I've got a little different perspective than most, just because I was in the wealth management space for about 13 years in a prior life, all the early 2000s, kind of 99 through 2012. And what we talk about and what we've explained to these funding institutions, that most what I call good operators, or most borrowers, they grow in down markets. They grow in down markets because, exactly as you said, Mike, clients are looking for advice. And the clients that aren't getting advice from their advisor are potentially looking to hear from somebody else. So they're willing to take that meeting. Versus in an up market, they open up their statement every time and they look at it, it's up. Why would they need to talk to a different institution but potentially give them advice, right? So the ones that they work hard, they roll up their sleeves in down markets. And again, they do well in that. And that's another thing that's helped the banks or the funding institutions get comfortable with these spaces, because as we've brought on more banking partners or funding partners and explained to them the nature, non-cyclical side of this, right? And that they actually grow in down markets. Again, they just looked at us like we had three heads. They didn't believe us. They're bankers. And so they got to try to figure out something wrong with everything that's out there. Nick's a recovering banker, so he's kind of laughing about this right now that he works for us.
Recovering banker, I love it.
Right. Well, that's what we call the guys that work here, guys and gals that work here, recovering bankers. They chuckle about it. I don't know if they really like it. Now, Nick's going to try to call me a banker, and we'll just stop that right now because I'm definitely not a banker. But what the funding institutions have found is when they look at these, and we were telling them that the really good businesses were going down markets well past what the market has done to their business, and now they're seeing it. They're seeing net inflows of significantly more than what the market has dropped. It's real to them, and it goes back down to the comparison I made to the COVID type drop, right? Yeah. These businesses do well. The good operators, the people that are trying to scale their business, not only through acquisition, right, but also do it organically in the way in which they grow clients. It's just, we believe that we're in a time that this is still a new vertical from the lender's perspective, but also from a borrower's perspective, them starting to understand how they can scale using conventional retail debt. We're early into this cycle, and we're in the education phase, frankly.
I love that you just kind of teed up the segue for me there. Like, let's shift gears to the advisor, right? To the RIA and their perspective. We've talked a lot about the lender's perspective here, why they find this segment really attractive. But why is now the right time for those growth-oriented advisory firms to consider using a commercial loan to acquire another business or to use that capital to expand their business in other ways? Nick, have the down markets, which have likely resulted in some AUM decline, right, for advisors, have they affected the multiples or the growth expectations for the the post M&A businesses that may arise from borrowing for that purpose?
Yeah, contrary to what you might think, with the market going down, it'd have a direct negative impact to these firms. It's actually not reflecting that on a valuation perspective. And I think there's a couple different reasons. I mean, one, to the great point Chris brought up a little bit ago of they like to add clients in a down market. And then secondly being these valuation firms do a great job of looking at historical operations and then future projected values and revenues. So what they do is they take all those things and put it into one value. And so this blemish that's occurring right now is not really as impactful as one would think, because they're able to go out and look at historical trends of what the market does after a pullback and look at the historical operations. So in terms of valuations and dollar amounts, that hasn't really moved too much. And then in terms of multiples, the demand is still there. I mean, we're as busy as we've ever been, and we're seeing transactions and competition more than we've ever seen. So the multiples aren't taking a hit either. And with those two things in tandem, we're really not seeing any sort of negative impacts to values and sales prices.
Are you seeing, Chris and Nick, are you seeing any decline in maybe like buyer demand? Meaning, like, I know prior to rates going up, I had several conversations with members of the team who were saying, listen, there's that 50 buyers to every one seller out there type of thing. And then, you get the list down smaller to how many qualified buyers there are to one seller, right? So not all those 50s are qualified, but have some of the kind of, let's call it pretenders, if you will, kind of washed out a little bit, and like we now see higher quality on the buyer side?
It's a great question, and it to me, it kind of goes with where the market is and the volatility of the market and where people, almost how they run their businesses, right? If they're very emotional about how they run their businesses and the way in which they talk to their clients and all those things versus systematic, that's the same way that some of these people flow in and out of the buyer pool, right? If there's volatility in it and they think multiples are too high, they're going to call and tell you, I would never buy a deal at these types of multiples. I think people are crazy right now. And then as things settle down, they may come back and like, you know what, I was a little dramatic on that. And I recognize now how these assets perform. And I see most of them are trading at maybe a little higher type multiple. And as I actually do my homework and looking at the cash flow and seeing the impact on maybe a little higher multiple and maybe a little higher rate, and recognizing that it's not that big a difference to what is their actual value over 7 or 10 years after they pay off the debt, they'll settle down, right? So do we see the pretenders getting out? Yeah, kinda. But those pretenders still call and say, hey, if you got a good deal for me, call me. Well, okay. You and everybody else says that, right? So it comes back down. It comes back down to commitment. And what I referred to this before, and I kind of always refer to this, maybe over to the real operators. Okay, the real buyers are going to buy in down markets and up markets. It's like real estate people. They're going to buy Class A properties all the time, whether values go up or values are down a little bit. It's location, it's location, it's location. So that real operator says, I'm going to buy revenue, and sometimes the multiples are going to be higher than others, but it's not just the multiple. It's how do we work together, right, with that firm that wants to sell. It's also the seller. They want to make sure they can go get the highest multiple out there, potentially from a private equity firm or whatever it might be, or some large roll-up firm. But it may be important for them to be able to transfer their clients to what is that next generation of an advisor that's going to handle the next generation of the client, right? So there's so many things, Mike, that feed into that marriage, that acquisition, that there's still a lot of buyers out there and not enough sellers. But this is still a demographics play, and we're early.
Yeah. And I like the fact that several times so far we've talked about not focusing too much on whether you're paying a bit of a premium, whether that premium is in the cost of capital, right, from the interest rate, or the premium is in the multiple. Because if you're growth minded, you're buying for the growth, right? And that kind of shifts us to kind of the NewCo conversation, right? So one of the things we've talked about on prior webinars and on the Advisor Financing Forum podcast is that SkyView and your funding partners look at deals based on that NewCo valuation, if you will, right? The combined entity that will result from an M&A deal. So, we're not just thinking about, hey, can this existing business afford to carry this much debt, right? We're thinking about like the new company that will result after this one company buys another company, or these two companies merge. Can that one carry the debt, and will that company be able to grow? So let's spend a few minutes there. Like, why is NewCo the driving force when it comes to your evaluation? And should advisors adopt this mindset as well? Like, should they be thinking more about like, what is my new entity going to look like before they even get here?
Yeah, I mean, in this vertical, which is different than others, they do take the combined values or combined revenues or combined cash flow, and they will account for that pre-transaction, which a lot of other verticals won't. So that makes it different. And the way that we like to think about it is when a firm is looking at another one, they're wondering if they can buy a like-size firm. And again, the numbers will tell us whether they can. We don't know the expenses of each side of it, but this is one of the few verticals or asset classes where actually a smaller firm can buy a bigger firm, right? Because we combine the two together. Now, I don't know if they can afford the whole thing, or there's got to be some sort of structure in there. But in most verticals, that conversation couldn't even be contemplated. Yeah. Right? And so when we look at the combined entities, or NewCo as you call it, it's a very important factor, because revenue buying revenue is accretive to the transaction, I always say, right? So our goal is to put the two together and make sure that we aren't setting any types of fuses in there or short-term problems that's going to create an end of our runway faster than we want. Right? So our whole goal is, when we're advising clients on the debt side of it, what can this transaction afford, right? From a debt perspective. And then how do we also make sure that we're able to continue to create runway, out in front of us. So if or when that next transaction comes in front of us, we haven't tied our hands behind our back, we can't do it. So NewCo is really important in not only getting the existing transaction done, but also having the foresight to be able to look forward in what that new thing may be, which again is going to come back down to the right funding partner and them understanding in this asset class, which we've spent a lot of time making sure we've got an entrepreneurial type banks in here with us that can look at it this way. So yeah, it's a big deal, NewCo, and making sure it's set up right, not only for the transaction, but the future.
That's really smart. And Nick, you've talked about this in the past too. Like, if you're thinking like interest rates, and I'm just making up numbers off the top of my head, so these are not the actual numbers, but if, whether the rate's at 5%, 7%, 8%, 9%, the expectation is that NewCo is going to produce more growth than 5, 7, 8, 9% over the lifetime of the new entity, right? So that it should absolutely be able to support, like, so those rates really shouldn't be scaring off an acquisition partner.
Yeah, 100%. I mean, one of the things that we try to do a strong education on is getting these clients to understand that, a 15 basis point rate change, I mean, even a 2% rate change doesn't make these deals not work. And so if you want to buy the practice and you like the bones of the practice, the rate shouldn't be the thing that stops you from going and growing exponentially by acquiring this book. And so, Chris and the rest of the finance team do a great job of actually walking through each individual opportunity with the client and showing them that on paper.
Love it.
I think that's let me parlay into that a little bit though, because I think that's a big deal. The numbers drive the conversation. We can talk about all the different things that we've seen or can do, but ultimately it's those numbers of NewCo or the businesses. And it's not just talking about, but it's ferreting them out on paper to be able to show them and give them something concrete to be able to digest as we look at trying to grow them. So I think Nick's spot on. I mean, showing everybody and educating everybody how these two companies work together to go forward. And 8% or 5%, the numbers either work or they don't.
Great. Fantastic. Well, we're pretty much ready to wrap it up here. But before I let you guys go, who doesn't like a little crystal ball time? So as you look out at the horizon for the rest of 2023, what do you expect to see from the Fed, and how do you expect that to impact the lending ecosystem for RIAs and independent financial advisory firms? I think it's probably like last year, right? Like whether the rates go up, go down, it really shouldn't affect deals, right?
Yeah, I would say my crystal ball, pretty much like everybody else's, probably pretty cloudy right now. The Fed expects to increase rates here, and then it's going to be like an increase in hold based on the last meeting. That's just what they're projecting. But like we've kind of talked about with rates and impacting these opportunities, we haven't seen a lot of impact from actually getting these opportunities done. And so whether the rates increase by 1.5% or decrease, we still want to make sure that the opportunity is the right fit for all the other reasons, and it will likely still support that opportunity. So, Banker Chris probably has a better crystal ball than I do, but that's my 2 cents.
Well, Nick lives in, we're here in Minnesota, and Nick lives in a snow globe, so obviously he just shook himself there, calling me a banker. Look, I think 2023, we don't know it may impact us more than we think it is, right? We're obviously bullish in what's happening here in the market, but that's because we've continued to have flow. What we need to be consistent is continuing to not only educate the advisors on what the market is bearing from a lending perspective, but also communicating and educating with our funding partners what's happening inside of the market, right? And we know that it's going to change because it always does. And so what are people not only able to do but willing to do are important for both sides of it. So we'll continue to work through that. And look, it's going to change, and if rates continue to go up, or we run into a recession and they're going to start ticking down at the end of the year, we don't know, but we need to be able to be nimble. And that's why we have multiple institutions, right? That's one of the biggest things I think as we look forward, as we continue to add more. Our partners want to know what the market's saying. In the market are our advisors and the transactions and why they are or are not getting done, and vice versa. The advisors want to know what the funding institution market looks like or what those partners are doing. So we continue to educate on both sides of those. And I think that's a value to it. We'll operate in whatever environment there is, whether it's up or down, we'll be educating.
Perfect. Well, that's the end of our webinar. Thank you very much for joining us today for our first borrower briefing of 2023. Chris and Nick, you were both fantastic. One of you more fantastic than the other. I'll let you guys battle that out. Thank you both for joining us and sharing your insights and wisdom today. Now, before I let you go, please make sure you swing by SkyView.com to learn more about the lending process and options for your business. And if you have any questions, simply call 866-567-6282 and a member of the team will be happy to provide you with all the help you need. Thank you all. Have a great day. See ya. Bye.
Thanks, Mike.
Thank you.
See you guys.